Welcome to After the Bell, the Capitalists versus Consumers Daily Market Report. Here is everything that moved the market today, Tuesday, May 12, 2026. Today was a significant day. Inflation came in hotter than expected, the highest reading in 3 years. Kevin Warsh was confirmed as the new Federal Reserve Chair. Chip stocks that had been on extraordinary runs got hit hard, and the market absorbed all of it remarkably well given the severity of the data. Let's get into everything. This video is for educational purposes only and not financial advice. Please hit the like button and subscribe so you never miss a daily report. Let's get into it. The numbers at the close. Today's session was messy but resilient. The S&P 500 closed down approximately 0.2%. The Nasdaq fell approximately 0.7%, the worst of the major indexes today and unsurprisingly so, given the chip stock carnage. The Dow Jones Industrial Average managed to stay essentially flat, finishing just barely positive, a remarkable performance given the inflation shock. The Russell 2000 Small Cap Index gained 0.33%, an interesting divergence we will explain shortly. What is remarkable about today's close is what did not happen. The CPI print was the worst in 3 years. The Iran deal is effectively dead for now. Oil closed above $102, and the market absorbed all of it without a catastrophic sell-off. The indexes went from being down over 1% at the worst point of the day to recovering significantly into the close. That recovery is itself a statement about the resilience of this market. The CPI report, the most important number of the month. This morning, the Bureau of Labor Statistics released the April Consumer Price Index, and the number was worse than almost anyone expected. Headline CPI rose 0.6% month over month, putting the annual rate at 3.8%. That is the highest annual inflation reading since May 2023, exactly 3 years ago. The expectation was for approximately 0.3% monthly and 3.4% annually. The miss was significant. The primary driver was energy. Gasoline prices surged 28% year over year. Fuel oil jumped 54%. The Iran war and the closure of the Strait of Hormuz are directly responsible for both of those numbers. The energy spike is entirely geopolitically driven, not economically driven. But here is the part that really worried markets. Core CPI, which strips out volatile food and energy prices to give a cleaner picture of underlying inflation, rose 0.4% month over month and 2.8% year over year. That core number came in above the 0.3% monthly expectation. Core inflation is not supposed to be affected by oil prices, but shelter costs, services inflation, and other components all came in higher than expected. The Northlight Asset Management Chief Investment Officer put it clearly: inflation is moving higher again as the war in Iran and the associated closing of the Strait of Hormuz is impacting both the headline number as expected, but also the core, which was even higher than expected. The implication for the Federal Reserve is significant. The Fed's target is 2% inflation. We are at 3.8% headline and 2.8% core, both moving in the wrong direction. This virtually eliminates any possibility of rate cuts in 2026. And according to CME FedWatch data by this morning, there was a nearly 30% probability of a rate hike before year-end, a reversal from just weeks ago when rate cuts were still being discussed. A rate hike in 2026 would be one of the most significant monetary policy developments of the year. Higher rates mean higher mortgage costs, higher credit card rates, higher auto loan rates. Every American carrying variable rate debt feels a rate hike immediately. Kevin Warsh, confirmed as Federal Reserve Chair. This afternoon, the Senate confirmed Kevin Warsh as a Federal Reserve Governor in a 51-45 vote, clearing the path for him to be named chair on Wednesday. Warsh will succeed Jerome Powell, who exits Friday as inflation hits a 3-year high driven by the Iran war. The timing could not be more dramatic. Warsh takes the helm of the most powerful financial institution in the world on the same day that inflation reaches its worst level in 3 years. His first major policy decision, whether to hold rates, cut rates, or raise rates, will be made against this backdrop. Warsh has advocated for regime change at the Fed and has signaled that interest rates could eventually be lower. But he is also a known inflation hawk, taking over during an inflation spike with energy prices surging and core inflation above target puts him in an extraordinarily difficult position immediately. Powell will remain on the Fed board until 2028 to oversee an internal probe, meaning the dynamic of Powell sitting at the same table as his successor Warsh begins immediately. Chip stocks get crushed. The chip sector, which has been the engine of this market's record highs, took a significant hit today as the inflation data shifted the rate outlook. Here is the logic. Chip stocks and AI-related technology companies have been trading at extremely high valuations because investors were pricing in a low interest rate environment for the foreseeable future. When inflation comes in hot and the possibility of rate hikes emerges, high multiple growth stocks are the first to reprice because higher rates reduce the present value of future earnings. Qualcomm fell 12%, its worst single day since 2020. Intel declined 9% despite being up approximately 430% over the past year. Micron fell 3.6%. The entire semiconductor index, the SOX, dropped sharply. But here is the critical context. Even after today's sell-off, the SOX is still up approximately 29% over the past month and 60% since the beginning of the year. Today's decline is meaningful, but it is a fraction of the extraordinary gains that preceded it. This is profit-taking amplified by the inflation shock, not a fundamental change in the AI demand story. The market divergence. Growth versus value. Today's session illustrated the K-shaped market dynamic clearly. Growth stocks, high multiple technology companies, sold off hard. That is the Nasdaq's 0.7% decline. Value stocks, lower multiple dividend-paying companies with predictable earnings, held up well or even gained. That is why the Dow barely moved and the Russell 2000 actually rose 0.33%. Coca-Cola gained today. Johnson & Johnson held up. Walmart was positive. These are exactly the types of dividend-paying companies we covered in today's Day 33 script. And today's session is a perfect real-world example of why dividend investors value their portfolios differently than growth investors. When inflation spikes and rate hike fears emerge, dividend stocks become more attractive. They are essentially inflation-resistant income generators with predictable cash flows. This is also why we talked about diversification in yesterday's After the Bell. A portfolio that owned both growth stocks and dividend stocks today performed better than one that owned only semiconductor names. Winners today. On a day when most technology stocks fell, several names bucked the trend. Netflix gained in today's session. Defensive consumer spending on streaming is proving resilient, even in challenging macro environments. Zebra Technologies rose meaningfully. The enterprise technology company is benefiting from AI adoption in warehouse and logistics operations. Plug Power surged 11% after reporting strong revenue growth and progress toward profitability by Q4 2026. The hydrogen fuel cell company has been one of the more volatile names in the clean energy space, and today's move was significant. Quantum computing surged 27% after reporting revenue growth from $39,000 a year ago to $3.69 million in Q1. That is extraordinary percentage growth on a small base. A reminder that some quantum computing companies are moving from pure research to actual commercial revenue faster than expected. Cerebras Systems, the AI chip company whose IPO was derailed by a national security review in 2024, is back and set to price its IPO tomorrow for a Thursday listing. With new partners including Amazon and OpenAI, this could be one of the most significant AI IPOs of 2026. We will cover it closely. The Warsh rate hike question. Let's spend a moment on the rate hike probability, because this is the most significant new development for everyday Americans from today's session. A few weeks ago, the market was pricing in 2 to 3 rate cuts in 2026. Today, the market is pricing in no rate cuts and a nearly 30% chance of a rate hike. That is an extraordinary reversal in expectations over a very short period. What does a rate hike mean for you personally? If you have a mortgage, a rate hike does not affect fixed-rate mortgages. But if you have an adjustable rate mortgage, your rate will rise when the Fed hikes. If you have credit card debt, credit card rates are tied to the federal funds rate. A rate hike means higher minimum payments and more interest accumulation on every dollar of credit card balance. This is the most direct and immediate impact on most Americans. If you have a car loan, same dynamic as credit cards if it is a variable rate loan. If you are a saver, rate hikes are good for savers. CD rates, high-yield savings account rates, and money market rates all go up when the Fed raises rates. The 4% CD rates we covered in our stocks versus bonds versus CDs video could go even higher. If you are an investor in growth stocks, rate hikes are negative in the short term because they reduce the present value of future earnings. Today's chip stock sell-off is a preview of what happens when rate hike expectations emerge. What to watch tomorrow and beyond. Tomorrow brings the Producer Price Index, wholesale inflation data. After today's hot CPI print, the PPI will either confirm or complicate the inflation picture. If PPI also comes in hot, the rate hike probability will likely rise further. Cerebras Systems IPO pricing tomorrow. This is the biggest AI IPO of 2026 so far. With Amazon and OpenAI as partners and AI chip mania driving the sector, the reception of this IPO will be closely watched. Kevin Warsh is officially named Fed chair tomorrow and begins his tenure at the most challenging possible moment: high inflation, geopolitical crisis, and a market that just had its most concentrated rally in years. Thursday brings retail sales data, the most direct measure of whether consumers are actually cutting spending in response to higher prices and inflation. And Nvidia reports earnings on May 20th, now 8 days away. Today's inflation data and rate hike fears add a new layer of complexity to what was already the most anticipated earnings report of the season. The bottom line for everyday investors today was a wake-up call. Inflation is not beaten. The Iran war is keeping energy prices elevated and feeding into the broader price level. The Federal Reserve under new chair Kevin Warsh inherits a genuinely difficult environment. But let's put today in context. The S&P 500 is still up significantly year to date. Earnings growth is running at approximately 15 to 20% annually. The AI build-out is generating real revenue and real earnings. And the market absorbed a significant inflation shock today without a catastrophic sell-off. For long-term investors, the inflation news is concerning but not panic-inducing. Inflation has been elevated before. The Fed has raised rates before. Markets have navigated those environments before. Patient, diversified investors with long time horizons have historically been rewarded for staying the course through inflation cycles. For people carrying variable rate debt, today's session is a reminder that paying down that debt aggressively is not just a debt payoff strategy. It is also an inflation and rate hike defense strategy. Every dollar of high-interest variable rate debt you eliminate before a rate hike is a dollar that cannot be hit by higher rates. Stay diversified, stay consistent. And if you are carrying variable rate debt, accelerate your payoff plan. That is your After the Bell report for Tuesday, May 12, 2026 here at Capitalists versus Consumers. Please hit the like button. It helps more people find this content. Subscribe and turn on notifications so you never miss a daily report. Every Friday after the close, we do our full weekly breakdown right here at Capitalists versus Consumers. We will see you at the closing bell tomorrow. Recommended reading for investors: The Psychology of Money by Morgan Housel, The Little Book of Common Sense, Investing by John Bogle, A Random Walk Down Wall Street by Burton Maltby. This video contains affiliate links. I may earn a small commission at no extra cost to you.